Hello, this is Chuck Carnevale, and the single purpose of this video is to illustrate that the market does not always price stocks appropriately, especially over the short run. Secondarily, the purpose of this video is also to show that in the long run, stock prices will correlate very closely with a company's operating results. But the real theme of this video and the article that accompanied it is to point out that you should never take your investment advice from the market, especially short-term market movements. A stock price can be dropping and create an opportunity, and it can be rising and create great risk. So I'm going to take a look at 11 different companies here very quickly. I'm utilizing the metric EBITDA, earnings before interest, taxes, depreciation, and amortization, as a proxy for the company's true worth value, and simultaneously to illustrate how the market will price a business according to its business results over the long. I'm going to keep things very simple here. So just so you're clear, I'm going to look at EBITDA over as long as I can for each company, and I'm applying the normal price to EBITDA multiple that the company has traditionally traded at to give you a sense of valuation. And then I'm going to overlay monthly closing stock prices and correlate those with that fundamental metric and show you clear periods of time when the market is fairly pricing, underpricing, or mispricing a security. With my first example here, AmerisourceBergen Corporation, you can see first of all that over time the stock price does go where the EBITDA goes. But you also see periods of time where the market undervalued the stock, and then of course we had a strong recovery, and then you see periods where the market dramatically overvalued the stock. And these are what I referred to in the article as obvious mistakes to avoid. You would not want to sell the stock when it was trading down here at this undervalued level, nor would you want to buy the stock when it was so significantly overvalued. But when you look at the business behind the stock and then look at stock price in relation to those business results, you get a very clear picture of whether your investment decisions are sound and intelligent or not. With my second example, I'm going to look at Albemarle Corporation, and again you see this historical correlation between EBITDA and stock price over time, but what I really want you to focus on with this particular example is how the stock price has dramatically risen above anything that resembles true worth valuation. This is what I would call a hype issue. This company is one of the largest producers of lithium in the country, and lithium of course is being used in electric cars and other lithium battery products, and so lithium has gotten very hot, and you can see that people have driven the price up to what I would consider to be unsustainable levels. If you look at it historically, there were other times when the price got dramatically above what I would call reasonable value or true worth value, and it always recovered. And I also want you to notice how volatile stocks can be in the short run. Look at the variation in valuation over this short period of time here. Again, high valuation coming back to normal, and now we have this ridiculously high valuation level currently. It makes no sense to buy this stock today. In fact, had you bought it when it was reasonably priced, this would certainly be a candidate that you might want to consider taking some profits in. My next example looks at Cisco, and I can look at almost any high-profile tech stock looking back into the 1998 to 2000 era, and you see ridiculous valuations. To me, this is probably the best evidence you'll ever see of how the market can completely misappraise the value of a business, and then of course you see the accompanying results. We had this ridiculous increase in price over this 2-year period, followed by a significant drop in price back to something that was closer to intrinsic value. Stock prices can be pathological liars, and they cannot be trusted. My next example looks at the railroad CSX, and again I want you to see this correlation over the long run between price and earnings, but I chose this example because it offered some very clear periods of time when price got significantly disconnected from fair value and then got significantly disconnected on the downside, followed by overvaluation again. I want you to notice how price always tends to revert to the mean, and currently, like we saw with Albemarle, we have a stock price that is completely disconnected from anything that could resemble intrinsic value or the fair value of the business. This is what I referred to in the written part as obvious mistakes. When you see a stock trading at this kind of valuation, you should be automatically warned that something isn't right and that it's market hype and not fundamental value that's driving the price. My next example is Disney, and once again we see periods where price becomes disconnected from fundamentals, but we also see a long-term correlation again where price essentially moves to where the business performs over time, but we get these periods of opportunity and periods of high risk from time to time. The market is not always pricing a stock according to fundamentals, as I indicated in the article. The apparel retailer FOSL Group is one of my favorite examples here because it really shows how irrational stock pricing can be. We can see during this period up through 2014 when FOSL was actually generating very strong operating results relative to EBITDA, but we also see periods of highly emotionally charged price action. This huge rise here followed by a significant drop, another followed by a very short-term huge rise, followed by a short drop, followed by another rise. And it's clear that the valuation of FOSL couldn't have changed as much as it was changing during this period of time here. But perhaps more to the point, we also see a very clear picture that price correlates to operating results over time. The collapse in EBITDA over these last several years are clearly what brought the stock price down to these ridiculously low levels. It's more important to focus on the business you own and less important to worry about the price. But if you look at both of them together, you can typically get a rational idea and perspective of what's happening and why. My next example, Home Depot, shows a quintessential example of price going where operating results go over time. But we also see this irrational exuberant period back in 1999 where the price got ridiculously overvalued. And again, this was obvious if you were looking at the company's stock price in relation to its business results. It's more about the business than it is the short-term price volatility. Nike is a very high-profile stock that I think really tells a couple of interesting stories. First of all, if you look up through 2012, you see this very highly correlated relationship between EBITDA and stock price over the long run. The company typically trades at around 12 times EBITDA. And then even though earnings growth didn't change dramatically, you can see that this stock got very popular and it had a tremendous run for 2 or 3 years. And I'm never denying that this cannot happen. I'm simply stating that it's unreasonable, it's not rational, it's not fundamentally supported, and we're now starting to see a potential of Nike coming back to, or reverting to the mean, coming back to near true worth example. The key is you should be able to recognize very clearly irrational pricing when it manifests when you look at a company and its stock price in relation to its fundamentals. My next example looks at Ryder System Inc., and I just think this is a classic picture of how irrational stock prices can be. If you look at the volatility of prices here over shorter periods of time, these huge rises followed by significant collapses over and over again, you get a real clear picture that the market can be very emotionally charged and driven over short periods of time, but once again you still see evidence that in the long run the price tracks fundamental results. But in the short run you can have some really crazy things going on, as you see here with Ryder System. I chose the utility stock Scan as my next example to illustrate very low growth. I want you to notice that the company's EBITDA growth rate has been very low, and this is primarily a dividend play. It's a high yielding dividend stock, but you can see what happens when price gets disconnected from fundamentals, not only how volatile it can be, but how dangerous. With a low growth stock like this, when you're buying it at high valuation, you're destroying any chance of having any meaningful capital return over time. With my final example, I'm going to look at United Technologies Corporation, and it summarizes what I've been trying to illustrate here. You see periods of undervaluation and overvaluation from time to time, but you also see this very clear long-term trend or correlation with stock price moving along with fundamentals in the long run. The market is not always pricing stocks according to fundamentals, and just because the price is rising or falling doesn't mean it's a good or bad stock. You always have to look at it in relation to its fundamentals. This has been Chuck Carnevale saying thanks for listening. I hope this helps you understand that stock prices are not always rational in the short run, and that you can avoid obvious mistakes if you pay attention to a company's true worth value in reference to its market value. Thanks for listening.